Hey everyone, I'm Nikki, and I've got some interesting developments in the mortgage world that are making waves in the real estate market. So grab your cup of coffee and let's dive on in. First up, let's talk about the elephant in the room, rising mortgage rates. The average rate on an ever popular 30-year fixed rate mortgage skyrocketed to 8% this week. Now, that's a level we haven't seen since the early 2000s. These rates have been on a steady climb for several months now. But why are we seeing the surge, you ask? It's all connected to bond yields, which are at levels not seen since 2007. Mortgage rates tend to follow the yield on the 10-year US Treasury. Now, as investors digest economic data, including housing starts and retail sales, it's adding to the uncertainty over the Federal Reserve's long term plan. So, what does this mean for home buyers? Well, these higher rates have led to a sharp drop in mortgage demand, with applications falling 7% in the last week alone. Now, the 30-year fixed rate was as low as 3% just 2 years ago. To put that into perspective, if you were buying a $400,000 home with a 20% down payment, your monthly payment would now be nearly $1,000 more than it would have been just 2 years ago. That's crazy, right? Home builders are using creative strategies to help customers afford their homes. Buy downs, where they offer lower interest rates initially, are becoming a top incentive. Even though some borrowers have seen rates over 8%, many are still locking into 7% range due to these buy downs and, of course, discount points, where you can pay a little bit of upfront interest to get a lower interest rate for the rest of your loan. Now, let's talk about the big picture though. The Federal Reserve has been aggressively raising interest rates to combat inflation, even though inflation has fallen from its peak. Now, this policy has pushed up the 10-year Treasury bond yield, putting pressure on mortgage rates. Housing industry has expressed profound concern about these rate hikes and their impact on the housing market. What's next? Well, the Fed is expected to raise rates one more time this year, with a decision coming in early November. The mortgage market is closely watching these developments as each percentage point increase in mortgage rates can add significant cost to home buyers. So, if you're in a market to buy a home, it's essential to stay informed and plan accordingly. But here's the interesting part. Despite the expectations that bonds would sell off after better than expected jobless claims data, they actually rallied. The data revealed a very tight labor market, and bonds had a 10-year yield of 4.983%. This has sparked discussion about whether 5% 10-year yields might represent a buying opportunity. Stay tuned for more updates on this front. And there you have it, folks, the latest mortgage news in a nutshell. If you found this information helpful, don't forget to give us a thumbs up and subscribe to more updates. As always, if you have any questions or more in-depth analysis, feel free to leave a comment below. And thanks for tuning in. I will see you next time.